Why does my screen look so small? All right, so we're live.
Hey.
Abby, every single week you changing up on me. Got the hat on this week, right? You took your right. We talked earlier, right? So you took your daughter to school.
Yes, this is why I'm so exhausted. She sucked the life out of me. So yes, I did drop Serenity off at Spelman. So now I can have all my time that she took away from me.
Now, now what year is she going into?
She's a sophomore now, second year.
It's Spelman.
Yes.
Boom, good deal. Awesome. I wonder if any Spelman people in the house, right?
If there's any Spelman people in the house, let me know. Definitely.
Well, good stuff. So I think we got a pretty decent show tonight. I'm excited about it just because this is probably something that a lot of people have been talking about, like my clients and stuff. And, I know we've been having great conversations lately. So I wanted to kind of stick in, some teaching, but some good teaching, some exciting teaching. I don't think I've seen anybody necessarily teach on what I'm about to go over online, like on YouTube and stuff. I mean, so I think this would be a pretty valuable it's going to spark a lot of questions. I know, because we got come up cousins and all this type of stuff that's like super technical and smart. So I'm looking forward to what I'm going to talk about, but I'm also going to, it's going to be interesting. Let's put it that way. I think it's going to be super interesting. Yeah. So let's do it. So guys, I'm Christopher Bush.
I'm Abby Joseph, your tax strategist, and welcome to another episode of Red Line. Hit it for us, Vic.
That's 100. That's 100.
What's good, family? Welcome to another episode of Redline. We have an amazing episode for you guys tonight. How to protect your retirement downside when it comes to your financial plan. It's so funny because when the topic came to mind, first thing I thought about is, I need to maintain my reserves, right? I need to make sure I have my 6 months and put away, especially with this recession. But I'm excited to learn what I need to know about protecting my financial plans.
Yeah, so I think it's really cool. When you look at typically, I guess our market, our audience, right? We come from a trader's background, right? And we talk about different ways to hedge your portfolio, right? And I think if we can agree that most of the time we should kind of have a long-term view on the market, especially while we're young, right? Of course, the market is going to be choppy. We're going to have ups and downs. And I understand that there's two different types of people, right? Abby, I don't know. We never really talked about this. Are you like a active trader, or are you like a buy and hold? I don't think we ever talked about like what is your view on like investments and how you do this stuff. What would you say?
I'm a little bit of both. So
Okay.
if any of you guys know of my teaching when it comes to trading, I full transparency, I believe in having 3 different accounts, right? The account that you trade, that you are scalping, you day trading in, or even swing trading, and that account needs to be under an entity, right? You want to trade that account under an EIN so you can write off your expenses. And then the other account that I have, I call that account my quarterly account. I kind of run that account like I kind of run the firm. Every quarter as a business, right? You're reviewing your financial reports. So every quarter, every company in the stock market, what are they doing? They're reviewing their financial reports. That's why they have earnings. So that account, I only trade earnings in it. And
Gotcha.
I only trade 4 times a year in that account. And pretty much in that account is probably a long swing, like 6 months, right?
Gotcha.
And then I have what's called my retirement account. That
Yeah.
account is my Roth, right? My Roth account. So the way that I do it is that My day trading account takes care my quarterly account, and my quarterly account takes care of my retirement account. So I'm not constantly depositing capital. I'm not constantly depositing fund in my portfolio, but my portfolio kind of takes care of itself. Kind of like your business, right? You have your tax account, right? You have your saving account, and you have your operation account. So your operation account is your main account, and it just feeds everyone else. So yeah, I'm a long-term girl. So the
Okay.
long term, it will go literally sits in the Roth IRA, but short term, yeah, we're playing with those.
Gotcha. Well, good stuff. You know, and I think this is good because you know, a lot of times what I've experienced. Okay, where sometimes we got put in a bubble, right?
Yeah.
So everyone online, that's a part of our community, or the different communities that have been talked about. A lot of
Mhm.
times we're really big on teaching people to manage their own investments, right? Trade yourself, those type things. But reality is there is a huge portion of our community that still need that extra education, right? That extra hand holding, that extra,
Mhm.
okay, I may not be able to learn this, be perfect right now, but it's going to take time. And that's what I encourage people, right? If somebody wants to trade, learn it, okay, great. But while you're learning it, you know, there are strategies that you can use that are tied and true that can help you build upon your plan, right?
Okay.
And you know, with a lot of the talks talking about, you know, recession, if we're in a recession, technically we've been in a recession, a technical recession, right? But nobody
Mhm.
wants to announce it for over a year now, right? Well, last the second and third quarter of 2022, I believe, right? We had two negative quarters of GDP
Yeah.
loss. But right now we're talking about even more. Okay, so now comes up, okay, well, Chris, how do I protect my portfolios, right? And so
Mhm.
traditionally, again, I would like to hear from people in the chat. Like, so traditionally, what are ways? You know, I want to hear from you guys. If somebody, you know, what are the ways that you guys are, or strategies that you can do to protect against a downturn inside of your investments or retirement accounts? What are some of those strategies that we talk about? Right.
I buy puts on investments. It
Okay.
like so say for an example, I have some 2025s or some 2024s. So what I do is I make sure that I hedge. It's so
Yep.
important to hedge, right? You want to make sure you hedge your portfolio to make sure that if the market wants to be bipolar in you, that you are hedging your long terms.
Yep.
Um,
Yep.
Sasha made a good point as well too. If it's stocks that you have, if you have more than 100 stocks, in a particular ticker, you can sell calls. I remember when Amazon went down, I tried to buy as much as Amazon stocks and then just started selling calls on Amazon. So there are a lot of strategies, but the biggest one I would say is hedge your portfolio.
Yeah. So again, and that's good, right? So for people that are active, right?
Mhm.
You know, active traders, or understanding, hey, look, I'm gonna sell calls, I'm gonna buy calls, I'm gonna do puts, I'm gonna short the market, right? That's a lot of things to go over, right? And I
Mhm.
think that again, that's something I do, but I know for a fact, I would say 99% of my clients don't do it. Right? 99% of my clients are not traders per se, right? And I would say almost 100% of my clients that are over the age of 55 don't trade at all. You know what I'm saying? So like,
Really?
so yeah, no. I mean, most again,
True.
when you look at,
That's
right, you know, so for most people, right, that they have a job, they have a 401k, they're investing in stocks passively, those type things, but there's a huge community that they don't just trade all day. Does that make sense? So my job tonight is I want to be able to from a financial advisory standpoint, right, as an advisor. Again, this is not a my disclaimer, this is not a promotion or anything like that, but this is education, because I want you guys to understand what is actually out there, to not say take over what you're doing, but assist your portfolio. Okay. Because you know, when I think about it, you know, we talk a lot about accumulation, right, on most
mhm,
shows, but not really many shows on how to, okay, now that I want to be financially free, not saying
mhm,
retirement has to be an age, but really a dollar amount. Well, even if you say, hey, look, I want to be done at 40. I don't want to be, I want to be done at 35. Whenever your financial freedom date is, okay, well, what is your portfolio doing passively for you that you don't have to
mhm.
manage? Make sense?
It
So
makes
one
perfect sense. It makes
right. So
perfect sense. And I'm thinking, I need you yesterday.
So one of those ways that you can do that, like we talked about selling calls, selling, hedging against the market on puts. You can buy like, again, this is not a promotion, but a SQQQ, all right. You can do those different ETFs to hedge your downside and manage your portfolio. But when we're looking at a portfolio that's maybe saying, hey, look, I got a 70-30 portfolio. I got 70% into equities, right? Stocks, right? Maybe large cap, small cap, mid cap blends. You have a portfolio of equities, but then you may have a separate 30% that may be into cash and bonds, right? Typically, as we get older or as we want to be more conservative with the market, you may add some cash and bonds into a portfolio.
Yes.
However, for me, I'm not a huge fan of a lot of cash and bonds in a portfolio because again, like last year, we had a situation where not only was the equities were down, what also was down?
Bonds.
Bonds were down as well. So typically, historically, we're saying, hey, look, bonds are supposed to be a place to where, okay, we can have money in bonds, we can still get a decent return if our equities are down. But see, last year that didn't happen
At all.
right? So there's another strategy that I kind of want to bring to the table. It's called a registered registered ILA, right? A registered index linked annuity, right? So that's also like what we call a buffer contract. Okay, I'm big on saying, hey, look, we put insurance on a lot of things. We put insurance on our cars, our homes. We put insurance on everything else, but we don't typically insure our actual portfolios. Okay. And guys, this is not a presentation about IUL, whole life, or anything else tonight. Okay. This is like strictly investment. Okay? Okay, I'm not doing an insurance presentation. So what I want to talk to us about is using a product inside of a portion of your portfolio that you can use as like an all-weather to your account. Okay, so I want to introduce you to this, guys. It's called a buffer account, or you can use it as a registered index linked annuity, right? It's called, that's the technical term in the industry. This strategy that I'm about to show you guys has been around like since 2010. Most of the top well-known companies, they have a product like this. I mean, your Equitables, your Bright House, your Lincoln Financials, your Athenes. A lot of the top companies have this, and this is actually probably if you look at online, one of the top selling products in the industry now. Okay, of what it can do, and you guys are going to kind of see what it can do here in a second. Okay, so let me see if I can pull up my screen and start us out on all this real quick. Now I'm doing this.
So then if I'm looking at my portfolio, right, and I always tell people why it's so important to insure your assets. So if I'm looking at my portfolio, right, and I'm not so sure of what the market looks like in the next couple of years, this would kind of be like an insurance.
Correct.
Cover.
Yeah. This 100%. Yeah, you can. This would be a type of product that you can utilize inside your overall portfolio, and this is going to be pretty cool, guys. So hopefully, I can illustrate this in a good way so we can understand. I'm getting my screens together. Let me see if I can present real quick. So we're going to go to sides. We're going to go to we're going to present, and then we're going to go to share screen, and then it's going to say window, and it's going to say all right. So this is what we got. Can you guys see? You guys can see my window. Okay, let me blow it up a little bit more so you guys can see. And I hope this is cool tonight. So can y'all see okay? Right. Let me see if I can do this.
Make it a little bit bigger.
Okay. How about that? Is that better?
Bigger. Okay.
I'll make sure I draw pretty big. So let's think about this, right? So let me take this. We're doing this like real time in like PowerPoint, okay? So let's take a portfolio, okay? So this portion of it that I'm going to explain here is like a portion of your overall portfolio, right? So let's just say you have your main portfolio, and let's just go with the number of. I'm going to use an easy number. This is not, let's say it's normal, but just like an easy number of, let's just say 500K. Okay. So let's say if we have a portfolio of 500K and you're somebody that's close to retirement, or in retirement now, Or you may say, hey, look, I just want to add a little bit of insurance or protection onto my accounts, no matter what account it is. This can go into a non-qualified account, an IRA, a Roth. It can go on any type of individual account or a retirement account or a SEP account. It just can't go inside of a 401k, right? And an employer-sponsored plan, this product cannot go inside of. You would need to be 59 and a half to actually put this strategy that we're going to talk about with your 401k. So it can be done. It's just it can't be done inside the plan. Okay. So let's say if we have a portfolio of 250k.
Okay.
Okay. And we're saying, hey, look, we want to break this portfolio up into into segments. All right. We're going to say, hey, look, I want to take, let's call it 250k. We'll say half of the portfolio, and I want to add this strategy that I'm going to talk about here tonight with you guys to it. Okay. So let's just go here. Let me go to add. We'll say 250k that this portfolio is on. Okay.
Mm-hmm.
Right. So now what I want to talk about, let's divide this up in 4 different ways. Right. So we will say, let me get us. I'm setting up the tone. You're like, y'all probably say, Chris, hurry up and get to the point. I'm coming. I'm just got to sit.
He's getting there. He's getting there. We know you're getting there.
Just be patient with me. It's always interesting to explain this, and I'm trying to be compliant at the same way, guys. Okay, so and I probably should have had this in Canva before I started. That was my goal, but
I like it like this better.
We interact. Okay, so we're gonna explain. So out of the 500k portfolio, we're gonna say, hey, look, 250k this portfolio is gonna go to the strategy. Okay, so we understand these are the 4 ways that the market can work. Okay, so so we understand that the market can go up, right? Mm-hmm. We understand that the market can go what? Down. We understand that the market can go flat, right? And then we also understand that the market can be what? Choppy. Make sense? Perfect. So understanding that is like, for me, I want to make sure that I have a portfolio, especially going from where we are today, the economic environment that we're in today, going forward. I want to have a portion of my portfolio. Of course, we're going to be invested in equity stocks and ETFs and, Apple, Amazon, all that good stuff. But I also want a portion of my portfolio that can be all weather. I want to provide some type of downside protection, but I also don't want to cap myself that I say, well, I can't get a lot of the upside either. Does that make sense?
Perfect sense.
So boom. So this strategy does like here. Okay. So I'm going to kind of explain what it does with Equitable. So on the upside, all right. So on the upside, this is also called our standard segment of what you call the buffer account. So let me pull up this part of the presentation now. See if I think I have it in our standard segment. Dual direction. Let me pull this up. Let me exit out of that. We're going to say, let's see. All right, I think I got this covered. Okay. So this for the upside, okay, this is going to be a standard This is like what we call our standard segment in our enhanced segment. So let me present real quick. Let me go to stop sharing screen. Let me go to start sharing screen. We're going to share a window, and we're going to go to here. Okay. So we're going to use Equitable. Okay. Can y'all see my screen? Okay.
Yes.
All right. So Equitable is one of the companies that offer this type of protection to your account. Okay. So you can actually choose. Can y'all see this? Okay. You can actually choose on this account a protection level, right? Of -10, -15, -20, -40% level of protection on these funds that go into these accounts. Okay, that's the first thing. And I'm going to explain what this protection is. The second thing about these contracts is number 1 is growth potential. Number 2, the best thing that I like about this, guys, because everybody's, oh, Crystal, what about the fees? Just understand there are no explicit fees on this type of strategy or this type of product that you can add to your account. No explicit fees.
Even better.
Say that again.
Even better.
Right. So this is not, Crystal, what does it cost? They don't like it. So if you put $100,000 in, when you log into your account, you're also going to see what?
$100,000.
No explicit fees, right? Only time when it comes to with the fee, if you want to actually add a fund outside of an index inside his portfolio, right? There's different like fund options that you can add to this strategy, but most of the time I just typically use an index, the index funds for this, so we don't have any fees at all. So that's why it says 0 explicit fees. So please, in the chat, just let them know there's no explicit fees. Okay. So in this example, this is the best way to show it. Okay. So let's just say the clients say, hey, look, I have $100,000 to go inside this strategy, and they want to use a 20% buffer. Okay. Right. And I'm going to say 150% performance cap. And I'm going to explain that in a second. So a performance cap is technically like this. They're saying over a year or a 6-year period, the most amount of gains that you can get from this account is 150%. That's the performance cap. But in reality, Abby, when we actually look at the rates here in a second, they're also uncapped performance caps, right? So there's actually not a cap, right? Okay. So depending upon the buffer that you choose, sometimes there's not even a cap. So if the account does 100% rate of return in a year, then you would get a full 100%. Okay, so I don't want people to think, oh, that's what they get us, right? This is just for example purposes to explain the how the account works. Does that make sense? You follow me this far?
I'm following you so far.
Boom. So let's look at scenario 1, right? So if we look at scenario 1, let's say the performance cap is 150. Let's say you put in $100,000. Okay. So let's say if you put in $100,000, and let's say that the actual rate of return of your portfolio over a 1-year period, let's just say a 1-year period, is 165%.
Okay.
Okay. So since your performance cap is at what? 150, right? So you would not get that 165%, you would get the 150. So your account value at the end of the segment, either the 1 or the 6-year segment, we'll say a 1 year just to keep it simple, right? Your account balance would be about 250,000. Actually, I'm gonna use a 6-year segment to make it more realistic. Okay. So meaning over a 6-year period, right? The cumulative returns is 150 grand. So at the end of that time, your balance would be 250K. Does that make sense?
Mm-hmm.
Boom. So let's say at the same time now, scenario 2, let's say the performance cap is 150, the index performance, let's say you can choose between the S&P, the Russell, the NASDAQ. Those are the indexes that you can invest in. S&P, Russell, NASDAQ, and internationals, right? But we're just going to talk about the top 3 that I normally use. Okay. So that's let's say you put that same $100,000 in, and the portfolio only does, it does 100% rate or 105% rate of return over that period. Your account balance, you would get the full what? Whatever the index does, your account would get that same amount. You follow me?
Yep.
Everybody's cool thus far?
Mm-hmm.
Boom. This is where the buffer part comes in play. Let's say we had a year like we did last year, right? The overall S&P, I think, was down about 19% rate of return last year, correct?
Correct.
Boom. So if your buffer on this account that you choose is -20, let's say the market did a -18% rate of return. If you put $100,000 in, technically, what's supposed to be your balance if the market did -18%, Abby?
About what?
82,000, right?
Yes. 7.
Right?
Yeah. Correct.
Right. So yeah. So if we had $100,000 into a portfolio, right, and the market dropped, right, that the market dropped that -18%, right, we would have we're supposed to have $82,000 in our portfolio.
So we
however, what did it say our portfolio goes to?
100,000.
Because what happens is if the rate of return, if the return of your portfolio lies within the buffer, see the buffer is -20, right? Then we did -18% actual, they will erase the negative losses on your account and credit you back up to your principal balance.
That's awesome.
That's pretty dope, huh?
Yeah. We don't even need stop loss. It works as a stop loss.
Right? Right. So that's one thing. So now let's say last year we had a return of -22%.
Yeah.
Right. Well, your buffer is set at what?
20.
So that means technically you should have your portfolio balance should have been, right?
Mm-hmm.
It should have been 78,000.
Correct.
right? But see, now what happens, they will erase up to 20% of your of the negative losses, and you would only see a loss of 2%. So now your portfolio at the end of your segment would be what? 98,000.
98,000. You really only have 2% of a loss.
Exactly. So see, when it comes, see, I know I talked about this on a previous episode when we talked about the sequence of returns and understanding if your portfolio loses 10%, do you only have to next year, do you have to just get a 10% rate of return to get back to square?
No,
you got to make an 11% rate of return to get back to square. Let me see if I can pull that up real quick for people that have not maybe seen that portion of the show.
This is awesome. So realistically, the focus is to make sure you are under 20%. And even if you are at 20%, guys, your portfolio won't be affected because it's not over 20%. And even if you are over 20%, you are subtracting that 20% of whatever the increase is. And that increase is what you would actually be down on. This is better than a stop loss, because if my stop loss is a 20%, I lose 20%.
Exactly.
But if this stop loss is a 20%, I still break even.
Exactly. Isn't that dope?
That's dope.
Right. So that's people say, okay, I don't know about
and they consider, us boring. They consider tax and finance boring.
Yeah, like we got, we got some cool stuff.
Cool stuff.
Okay, I gotta find that slide. I'm gonna find it here in a second. I gotta figure out where I put it. Okay, hold on. I just downloaded it.
So the only realistic disadvantage is if the market really, really ran very good and we were hitting a 500%. Realistically, the only percentage I would be able to obtain is that 150. That's
exactly. But remember, like this is for you to understand. This is not for a person that's 20 years old. This is not for a person that's 30 years old. You see what I'm saying? Like this is okay. Most of the time when I'm developing a strategy for something like this, it's somebody that's over the age of 45. Right? It's really for somebody that's over. Let's say I really do it for my clients that's over the age of 50. Okay. Right? That are, again, these are people that are not trading, or even if you are trading, this is a type of strategy can serve as a foundation for your overall portfolio. You can still go trade. You see what I'm saying? But this is something that's okay. So let me go here. So
this strategy would be for let's just say one of the options you say is the Roth IRA.
Exactly. So, a portion of that Roth, a portion of your IRA, a portion of, again, it's not a whole account, your entire assets. It's a allocation. Does that make sense? You're allocating, and we'll talk about that on a whole nother topic, right? So let me kind of show you this. So that's the first strategy. This is really cool. Okay, so this is the first strategy of this first window, right? So we got here, let me go back to my notes. I have a bunch of notes to make sure I don't miss nothing. Okay, so that's for our upside strategy. That's called a standard segment, okay? The next thing that I like to talk about is what the market can also go what?
It can also go down.
We got it. We also, so now we got to be able to have a situation where we can have a portion of our portfolio protected from the downside. However, but we still want the opportunity to capitalize on the what?
On the upside.
Oh, dang it, man.
We're over here having church.
Man, we about to have church. Y'all know I like doing this stuff. I like it. Okay, so now I'm gonna go back to presenting again. So let me see if I can bring up this window. We'll go back to this one. We'll go back to.
So now what we're doing is now we're projecting that the market is gonna go down.
Yeah, so I need to know, hey, I want to have a portion of my portfolio already set up to where if the market goes down.
Yep.
Okay. So this is also can y'all see my screen? This is dope. So you see my screen? So this is what you call dual direction. So this is another feature inside this product, which is called dual direction. Can y'all see this okay? Is it big enough?
Well, I can't see.
Oh boy. How about now? A little bit better?
Yes.
That's too big. All right. So this is what we got now. So dual direction. So again, if you if we allocate a segment of your portfolio to this, we can use all these strategies inside one. So all these 4 strategies that I'm going to show you can be one strategy, and you'll have an all-weather portfolio on this segment portion of your account. Okay. Mm-hmm. So like I just did this for a client. She had like 1.5 million. So of the 1.5, 500,000 went into a strategy like I'm showing you guys here. All these strategies put together.
Perfect.
Okay. So let's look at it here. So now we can choose a -10, -15, or a -20% downside protection. Okay. But this is also called the dual direction. Okay. So it works the exact same as the standard that we just saw with one caveat, right? So I say here, look, if our performance cap is 110, right? But the actual account did 120, you would only get the 210 on that 100 grand. We talked about that same thing. If the market does 80% rate of return over that period of time, you get the 180. We talked about that, right?
Correct.
This is what's new. So technically, remember on the last screen, if the market went down -12% and it lies with inside of our buffer, what do we say? What do we say happens to that -12%?
That -12% doesn't affect us because
it doesn't affect us. So it would credit our account back up to 100 grand, correct?
Correct.
So now the dual direction is this: if the negative rate of return lies with inside the buffer, not only will they credit your account back up to, right, the 100 grand, they will flip the negative rate of return and make it a positive. So even in a down market, you still got a positive 12% rate of return and made it to 112,000 instead of 100 grand.
Amen.
I don't. Isn't that crazy?
Amen.
So they will flip the rate of return for you.
Correct. So it's a dual opportunity to have a dual positivity.
Yep. Even if the market's down,
even if it's down, we're making money.
You're still going to get a what? Positive return, even if as long as it lies with inside the buffer that you choose.
So then by understanding economics, right, and by understanding how the market function, it'll help us to know what percentage, right, our segment buffer should be.
Correct. So let's just say if you have $100,000 in a segment and I divide it into these four, I may have 25 in the first one, 25 in the second one, 25 in the third, 25 in the fourth. So it can be built this way, right? So this is, some things that we'll kind of talk about in the future, right? So if let's just say the return is a -18% on your portfolio, then of course you don't get the dual direction, but you will erase the -15% of the loss, and you would only lose that 3% on that portfolio, which can be made back up. Does that make sense?
That makes perfect sense. I mean, realistically, guys, when we lose, if your stop loss, let's just say your stop loss was 15%, realistically, you're not breaking even. You need to get back positive in order for you to break even. This is giving you an opportunity to either break even or make more. I mean, and the loss is so small.
Exactly. And you can always make that back up. That's what we want to make sure that we take that out. We take those huge losses out of that account. So this is why, again, like most of my clients, right, that it's fit for, if they're about to retire or looking at retirement, those type things, I want to add some protection, especially if somebody is 59 and a half, they're still working, have a 401k. Your money's like this in a 401k. If you're still working, you have no control over that. No. So you can do an in-service distribution, Abby, and add this feature onto those funds. Absolutely. And still contribute to your 401k.
And if you are 59 and a half,
and still get the match.
Exactly. And if this is in your Roth, guess what?
Tax-free.
That's like my favorite word.
Yeah. Right.
It's tax-free. Yep. So let's just say, I love scenarios. I love example. So let's just say, though, I don't have it. I don't have it in a Roth. Let's just say I just have it in a regular portfolio. There's 500K in this regular portfolio.
In a non-qualified account, a regular brokerage account, or a trust account, you can do the exact same thing. Right. So
especially if it's in a trust account, why not?
Yeah, you can do it in a trust, right? I got clients that have like $2 or $3 million in inside their trust, right? Because it's a long time.
Y'all see why I send you guys to him? Yeah. So like, especially, let me talk to my traders that are really profitable trader. So Chris says like he doesn't really have a lot of traders as clientele. I would say 80% of my clients are traders. 80% of my clients are traders. So for you traders that are out there that comes to me really concerned because you don't want to give IRS 37% of your taxes, and we have moved this money as much as we can, right? And you hitting these 5 million, 10 million, and you really don't know what to do with this money. It's important to put it somewhere and actually have a protection plan on it. And this is literally what I would say a perfect way, especially doing tax planning. A lot of questions my client will have doing tax planning. Okay, Abby, I have this money. I don't want to give IRS out of it. What do I do with this money? Well, if you have this money in your Roth IRA, or if you have this money in your brokerage account and you don't know what to do with it, then you need to reach out to Chris so you can actually protect it. I always tell you guys, money is a tool, right? If it is not being used or moved to make more money, then it's a liability. It's no longer an asset because it's just sitting there. Money depreciates. It does depreciate. So then having your money somewhere and being protected, listen, Linda, shoot, especially if I'm 20% down, I'm over here having anxiety attacks. But with this protection, even if I'm 20% down, because my threshold, right, because my hedge was 15%, I ain't got to worry.
Yeah. 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 So, so remember, okay, we're going back. So I know we were going to be longer tonight, but I'm going to cut it short. But I'm going to do, if people are interested,
No, we could do an episode 2.
If people are interested, I'll do like a Zoom, and they can also send me a message on Instagram or even LinkedIn or even the email, and I'll you can put all that up somewhere, Vic, in the chat or something. Let them know. And I'll actually do a one-on-one with people that need that. So I'm going to kind of show you how this works. Okay, so going back to our screen. So now we looked at the upside of the market. We looked at the downside. Now let's look at, okay, well, what if our portfolio is flat, right? What if we just have a market that's a flat situation? What do we do? Okay, so this is the next part of the strategy that you can use if the market's flat. Okay, let's see. So this one is called the dual step up segment. Okay, so you can do this in a -10 or a -15% level of protection. Again, all of these strategies that I'm showing, there's 0 fees. So if you say, well, Chris, what's the fee? There is no fee. I don't charge you a fee. The company don't charge you a fee. There's no fees. There's no fees. There's no fees. Okay, we good on that? People can say, Chris, what's there's no fees. Okay, we good. All right. So now let's look at this. If the market's flat. I need to blow this up because this is kind of small now.
Yay, thank you for us.
All right, so let's look at this hypothetical, right? So we're saying in this hypothetical that we assume that let's say take a 1-year duration. So we're doing this we're saying, hey, look, we got $100,000 and we're doing this for 1 year. Okay, this is a 1-year segment. Okay, this can be renewed every single year. Okay, this is a 1-year segment. Okay, all right. So you do have to keep this in for 1 year. This is not like, hey, I can have it for 3 days and pull it out. This is a 1-year segment, the duration. Okay? So we're going to say it's an 8% performance cap, meaning that the most that you can gain on this strat is the 8%. Okay. And then you're doing a 10% buffer. Right. And I just want people that maybe skip stuff. Remember, this strategy that I'm going over is not correlated to day trading, those type things. Because some people say, oh, Chris, at 8%, that's horrible. Okay, we're understanding this is trying to act like your bond position in your portfolio, your cash position in your portfolio, give you upside, give you diversity. If you're retirement, I want to make sure my money's there. Like this is a strategy that's a part of your full allocation, not all of it. Okay, guys. So don't give me a hard time about like people have to understand how to allocate a portfolio.
Yes, this is not your 6 months,
this is
reserves.
It has a place, and I want people, to understand that. So let's say if we have a down market, let's say the return on the down market is -12%, right? So that means since you had a 10% buffer, it absorbs a 10%, so you only would be down 2. Cool, right? We're good deal. So, but let's say we're in an up market. Right. And let's say the index only returns a 4%. Right. I think it was 2020. What was the last time? I think it was maybe 19 or 18. No, 18 we're down. I got to go back. I forgot one of the years that we were only like a 5% up in the last 5 years. There was a year that I forgot what year it was. Shoot, I'm sorry. I'm drawing a blank. But anyway, let's say the index returns only does a 4% return. Right. Because that return is positive. Even though the index, your portfolio only did a 4%, long as it was positive, they're actually going to credit you at 8% rate of return on that portfolio.
Because that's our threshold. Our threshold we agreed to was 8%, right?
Correct. So that's why it's called the step up portion of it. So as long as it's positive, so if the market does a 1%, 2%, anything less than 8%, you will automatically get that 8% as long as it's above zero.
Correct.
So again, so this is trying to protect on a flat market, because sometimes we are in a position to where the market is flat. We don't really
flat.
it's just choppy.
Not moving. Yep.
It was choppy. So even when it's choppy, I still want to have what? Growth at the end of a period.
Yes,
so
sir.
This is a way that you can have that upside growth at the end of a period if the market were to be what? Flat.
Yes.
Right. So let's say the market actually did, check this out. Let's say the market did a negative 5% return. Since that negative 5% is within the 10% buffer, not only will it erase the negative 5% losses, since your performance cap, right, is 8% and it's a dual direction, this also going to not only flip the 5 to a positive 5%, it's going to actually let you step up to the 8% performance cap. So even though your portfolio was down negative percent, it would actually be a positive 8% that you would realize inside your portfolio.
Correct. Now I do have a question.
Yes, ma'am.
All right. Let's just say we are flat, right?
Yeah.
But we are up 15 or 20%. Will I only be able to get the 8% since that's my threshold?
Say that again.
So market is flat.
Yeah.
My segment, right? My is 8%.
Yeah.
That's my up market percent. So, but let's just say the market hit 15, 20%, right? On the upside. I will only get 8% though.
Correct. On this part of your segment, right? If we're breaking it to 4, is this 25% of your allocation, and you would only get that 8% on that part, right?
Correct. That makes perfect sense.
But remember, right? Again, we're just doing this as a separate allocation, right? And you're going to have the other portion of your portfolio in equities that's getting the full 15. But see, we just want to make sure we have an active hedge against our portfolio, especially for a lot of people, right, that don't do all the selling, the options, the puts, and like they still want that feature. Well, you can have that.
Yeah.
And it'd be it's something that you don't even got to think about. And that's what I love, right? I'm big on, hey, look, I need to go to the gym more. That's my goal, right? So I understand that I need a trainer, but I understand there's some things I can do by myself, but I just need some extra help sometimes in different places. So I'm going to use support when I can, but also, okay, when I want to maximize growth and I know how to, then I can also do that as well.
Right? And plus, it kind of take care of itself.
Yeah, it's easy.
Like when it's managing the portfolio, whereas in our long-term portfolio, we're managing it, right? Yep. We're hedging. We're the one that's putting a stop loss, right? Yep. We're the one that's hedging with the puts. If we're in call, we're the one that's selling calls, but this is actually protecting it, not only protecting it, but it's also making us money.
Absolutely. So the last part of our strategy that we'll talk about, let's see, let's go back to the present. We're going to share screen. We're going to go to window. We're going to go to our PowerPoint. I'm gonna make this better the next time I do it. So the next part is a choppy market, right? So what can we do in a choppy market? In a choppy market, I want to be able to lock in, right, on the highs in a choppy market, right? Yes. So I want to be able to lock in. So if the market goes down, because like, for instance, sometimes the market goes up, maybe our account balance grows from 100 grand, right? And then it may go to like 200K, right? But then the next 6 months in a year, that portfolio may drop back down to like 175, right? So what we want to do, if we feel like the next part of the year that the market may be down or whatever, we want to have an option to say, hey, look, let me lock in this position at this time and have a buffer on this part of my account. And though I can always compound on my lock-in periods going forward. Okay. Yeah. So what I'm going to explain here is what we call like our 1 year segments or our annual lock. Okay. And this will be the last one and we'll be done for the night. Okay. So let's go here if I can find it real quick. If I can make sure I downloaded it.
While you do that, Troy, it's a yes. So if your buffer is plus 8% and the market return 15% for the year, then you are capped at that 8%.
On just this one part of the segment.
Correct. On that part of the segment.
Yeah.
My favorite segment is the first one.
Come on. Let's see if I can do that. Where am I looking at?
Listen.
All right, annual lock.
Make money up, make money down.
No. Yeah, and this is really, I mean, I really enjoy it, guys. Like I said, if I haven't told y'all, like even me, how I do my portfolio, I don't day trade or buy individual stocks for my entire financial picture, right? Even for me, I use ETFs, right? I use stocks, I use different things because I want some of my money passively. Because at the end of the day, again, I can't say that I have a 40-year track record and I'm better than Vanguard, I'm better than BlackRock, I'm better than State Street. You see what I'm saying? So I know that I want things that have been in service that I can count on, but then I also know a ton of strategies and know how to push my portfolio to new heights by me trading it or doing different options and doing futures, all that type of stuff. But I do want something that I know if I mess up on this one, if I blow up account, well, I'm not gonna do right. But I'm saying if you blow up account, at least I got my foundation set, right? Exactly. So let's
not your retirement account you're blowing up.
Absolutely. All right, so let's go to this last segment. This is like the standard segment. Okay, so this is for a 1 year. So you can actually do this. Check this out, Abby. You can do a -10, a -15, a -20, or a -40% downside protection. So if I have a client, I have a client. Y'all wouldn't even believe me. So I had a client that I got back in February. He literally has had his money in a money market account since 2008 till now, like a portion of it, like 150,000. I'm like, why have you? He's like, Chris, I just didn't know when to invest. I just left it there. He is so risk averse, right? Y'all wouldn't believe me, but there are clients and people out there that don't want any risk. They don't want, no matter how much I educate them on how the market works, what's the long term, and you don't have to worry about the short term volatility. They still gonna say, Chris, I don't want to lose no money. Does that make sense? So you do have a situation where you can have like a -40% rated, -40% downside protection on that account.
That's when my anxiety goes crazy.
Right. So let's look at this segment here. So what happens on the annual lock, right? So let me see if I can explain this correctly. Okay, I did. Hold on, that's not the right one. Is that the right one? Hold on. Wait, why didn't it download? 1 second, guys. I don't think it downloaded. I don't think I did something right. All right. What do y'all see now on my screen?
The annual lock segment.
Okay, cool. Then that's what y'all supposed to see.
Okay.
All right. So annual lock. Okay. So this is what it looked like. So all right. So if we're looking at the annual lock, let's say the market, the index does a 13% rate of return. Right. So your performance cap on this one is say 10%. Right. Let's say you have $100,000. So let's say on a year. So let's say, boom, the market does a 13% rate of return. So you would lock in that 10% gain on here. Okay. So let's say the market did a -5% rate of return. Right. What will happen? Technically, your account balance should have been down on that annual lock. Right. Hold on. I think I said something wrong.
The market is still at 10%. That makes 110.
I'm sorry. So your balance would have went to 110,000. Yeah. Boom, got it. So boom. Yeah. So in this case, it was a buffer of a -10%, right? On its buffer. So it would take out those negative losses, credit your account. So you would lock in that 110 again. Nothing changes. Okay. Right. So let's say the next year the market does 10%. Then of course you lock in 10%. But let's say the next year the market does -12. Yeah. Well, your buffer is at -10, so you would only see a negative loss of the
2%.
Boom. So if the market does 15, boom, you would get 10, so on and so forth. So this is like on the annual lock portion of your account. So what it's meant to do is that over time to compound and try to lock in those profits and limit your losses as you continue to grow your portfolio. Okay. Now, this is a situation to where, again, I went through all 4 strategies, but you don't have to have all 4 strategies into your account, right? Some of my clients just say, look, Abby, you say, look, I just like the first one, boom. Then 100% of whatever allocation can go to that first account. So not every time do I add this to a portfolio. Like in one of my clients, she's 40 years old. She still has a longer time horizon. So we don't necessarily have to use her annual lock or anything else on her account, because she wants to be protected, but she wants the growth, right?
Correct.
Allow growth with uncapped. She doesn't want to have just a 10% performance cap. She wants a performance cap of like 300% or uncapped performance cap. Does that make sense?
Yes.
So,
Yeah.
so again, there are, let me kind of, maybe I should show that too. That'll be the last thing that I'll show. And I'll go from there. Let me kind of show you
I want
guys.
to see the one that's not cap.
Yeah, I'm gonna show, let's go over those cap rates real quick so y'all can understand what I mean about cap rates. Where is that at? I know I had this somewhere. Hold on. Good stuff tonight, Abby. Is that okay?
Oh, definitely.
Hope everybody.
I'm looking for that 300. Yeah, the three sis, we're looking for that 300 or 500%.
Yeah. All right. So let's look at it here.
You know,
So I
it's
have,
real.
yeah, y'all are spoiled. Y'all can't take if it ain't 1,000, if it ain't a 3,000% rate of return, we don't want it, right?
We want 300 to 500% on cap. Let's go.
Right. So look at this. So think about. So this is really cool. This is really cool. Y'all can still see my screen.
Yeah.
All right. Check this out. So remember how we talked about on that standard segment in the beginning, right? This standard segment in the beginning, right? Even if you choose, think about this. If you choose, you can have a negative 10% protection, and you can be uncapped on your return. So it doesn't matter if the account did 1,000% rate of return, you would get 1,000%. So you see what I'm saying? So you can choose a negative 20% protection or buffer, but still get a cumulative 500% rate of return, guys. So a lot of people think, oh, okay, well, this is how they get you. No, like you can get a majority of the top side. Think about it. The market, when you look at the S&P 500, there hasn't been a 6-year period where the market has a cumulative return of 500%. Right? That means the market would have to do an 83% rate of return per year. Has that happened? No, it's not happened. So okay, so you can understand people like
it needs to make sense. It needs to make sense.
Right. So just understand, like you can have on the Russell 2000, you can say, hey, look, you can have a 20% buffer and still get 110% of the top side. You can do the internationals, right? 650%. You can do the NASDAQ, 95% on a 20% buffer, right? 150 on a 10%.
So you can play with it. You don't necessarily only have to use the S&P 500.
No, you can use a combination. So we build this. Right? So I know there's like so much I can talk about on this. And that's what I'm saying. Like if you guys have questions on like a strategy or implementing this inside your portfolio, make sure that you give me a call or send an email or put me on Facebook or LinkedIn. I don't know, one of those.
You can literally email him and Vic will put the email in the chat for you guys.
Yeah.
Okay.
Yeah, just email me. And then y'all have my my Instagram and stuff. I think my Instagram is what?
Yeah.
Christopher W. Bush. I think that's it. My Instagram. LinkedIn. You gonna put the email address in there, link? Vic.
Yeah, he did that for you. Okay. Perfect.
So that's a lot for us to go. I know we're kind of past, but I guess I wanted to kind of show you guys that because it's huge on the things that you can do to add protection to your portfolio, and it doesn't have to cost. It can be automated. I mean, there's so many different ways, and that's where when I'm having a consultation with my clients, it's don't think that when you're sitting out with the advisor, you only have to do you only have to do like just stocks and bonds or just ETFs. Like there's a plethora of things that you can do to really protect your portfolio that I really want to start going into, so I just hope everybody kind of enjoyed that overview of what some things that you can do inside your portfolio, which is pretty cool.
Awesome. I hope you guys enjoyed the show. Hey, listen, there's different ways for you to protect your portfolio, for you to protect your assets. It's not just trust. It's not just, sell calls. It's not just, hedging with puts. If you are not if you're not a day trader or a scalper, and you want to protect your retirement money, this is an amazing way, especially the biggest thing that Mark, listen to me. The biggest thing that, Chris said tonight is that there is no fees to these options. One of the reasons why I love trading option is because you have what? Options. So, Chris has done just that, giving you guys so many different options. Yes, we watched.
What's the email address? I forgot. Is it help at come up series or help at what's the email address?
The email address is, let me get it for you guys because y'all killing me.
Yeah, there it is. Help at comeupseries.co. That's it.
Thank you. Thank you, Vic. So email us. We'll continue the segment for you guys. Email us any questions that you have. Question: does this work for both our 401k and brokerage account?
Yeah, so it works for your brokerage accounts, IRAs. Like I can't, like if you have a 401k account, it can't go inside your 401k. But if you are over the age of 59 and a half, right, we can do an in-service distribution out of your 401k, move that to an IRA, and then you can apply that to your IRA funds, right? At no taxes, no penalties, no fees. Okay, so this is
favorite word, no taxes.
Yeah, no taxes, right? So you don't have to pull out of your account to make the strategy, right? It won't be any tax penalties or anything that you can actually add this to your portfolio. So it's really a cool thing to do.
Yeah, hopefully you guys took some notes. Don't forget to rewatch this. There was a lot of gems that I gave tonight. Thank you so much, Chris. I know myself, I'm going to be looking at this strategy so that I can sleep better at night, knowing if this market goes down, I'm going to make money. If this market goes up, I'm going to make money without Absolutely. I have to actually create a stop loss.
It's cool. It's amazing what you can do, guys. So I just really hope to kind of continue to bring you guys knowledge. And, Abby, I appreciate you for letting me explain this. I know this was I was driving like, dang it, what am I going to talk about tonight? It came to my mind like, okay, I'll go inside on this. So we'll make it happen. So
this was perfect. This was a learning for all of us. And I thank you guys for showing up. We will definitely see you guys next Wednesday. Don't hesitate. Don't forget to like, subscribe, and don't forget to share this video. Thank you again for coming to another episode of Redline. I'm Abby Joseph.
I'm Christopher Bush.
And we'll see you next week. Bye.
Bye, guys. All right. How was that?